Hi everyone, this is Eyal Tropin from My Property Funding and American Pacific Mortgage. I apologize. This is a re-recording of a live event that I did the other day. The recording didn't come out, so I'm re-recording offline, and hopefully I'll be able to post this everywhere for people who were not able to attend the live event. And I will try to post updates as the situation continues and as conditions change. So we're talking today about mortgage rates, real estate investments, and refinances at the time of Corona. This is interesting time. I want to start by with a couple of disclaimers. I am not a financial advisor. I'm not a tax advisor. I'm not a CPA or a lawyer. Please seek professional advice by people like that before making any important decisions regarding your finances. And of course, you're welcome to consult with me regarding everything that has to do with mortgages, which is my area of expertise. I am a licensed residential mortgage loan officer, licensed in California, Oregon, Texas, and Washington. I have a team of residential loan officers licensed in all 50 states. And I also own my own company, My Property Funding, where I broker out loans for real estate investors. So let's start with the most common question that I'm getting these days, and that is, so the Fed, the government has reduced interest rates to zero. Why aren't mortgage rates down to zero? The chart that you're seeing in front of you right now is a comparison between the 30-year fixed rates on mortgages in blue versus the effective federal fund rate, which is known as the Fed rate, over the past quite a long time, since before 1975. You can see the gray areas, the shaded areas are previous recessions. And if you follow the graph, you'll see that the general direction is the same for both the blue and the red line. But you have a lot of times, especially during the times of recession, where the Fed rate started dropping and interest rates kind of went sideways. And if we focus on the period between 2006 and today, you can see this more clearly, that in 2007, 2008, the effective federal rate dropped to zero, very close to zero for a period of time. And mortgage rates kind of moved sideways and didn't do much at all. The overall trend was down, but not much more than that. Why is this? The federal rate affects short-term interest rates. It has nothing to do with long-term loans, such as mortgages. It can affect credit cards, car loans, everything that ranges from a few months to maybe 5-7 years, something like that. When you go to periods of 10 years or longer, you should look at the 10-year notes, which is a type of bond. And if you look at mortgages specifically, we're talking about mortgage-backed securities, which are, again, a type of a bond. Usually in normal markets, it is considered relatively safe, conservative type of investment like bonds. So when there is uncertainty in the market and people are pulling their money out of the uncertainty of the stock market, they usually put it in more conservative financial tools, such as bonds and mortgage-backed securities. But these days, there's so much uncertainty with this global event that really people are pulling out their money, and they're probably putting it in cash positions, not investing it in anything. So we're seeing a situation where both the stocks and the bonds and the mortgage-backed securities are all dropping at the same time. And this is kind of unprecedented. It's putting a lot of pressure and a lot of uncertainty in the market. If we go and we try to focus this even more a little bit, and we look at just the mortgage-backed securities and we look at 1 month, you can see the trend that, you know, the more corona cases were coming out, people started to realize that this is going to have a vast economic effect. They started pulling their money out of the stock market and putting it into bonds and mortgage-backed securities. Now, the higher the mortgage-backed securities go in this graph, this is the secondary market where the lenders package all the loans as a mortgage-backed security and they offer it on the secondary market. And those are being traded by individuals, but also by organizations such as pension funds, by insurance companies. They're looking for places to invest their money, and they invest in mortgage-backed securities. And as they pull out of the stock market, they invest in mortgage-backed securities. Basically, they're making money on the difference between the price that they're paying on the mortgage-backed security notes and the actual mortgages. So as lenders offer those on the secondary market, if they can get more money in the secondary market, they can offer lower rates, lower interest rates to their customers. And that's what happened initially. But then more uncertainty came in. We started seeing cases of coronavirus in Europe, in the United States. The gravity of the situation started growing, and people started pulling out of everything. And this is what happened around March 9, where the mortgage-backed securities started to drop. Now, if you look at the right side of this graph, you can see each one of these bars is just one single day. And there has been a swing of 2 full points. This is when we're talking about mortgage rates. There is the par rate where you don't pay anything and you don't get any credits from the lender. That is 100%, 100.00. And here we have a swing between 100 and 102. That's 2 full points, 2% off the loan amount. That's the price difference in just 1 day. And the reason for this is in part an issue of liquidity. So banks are required to only have 10% liquidity. 10% of all deposits are required to be held in cash. 90% of the money that they have is invested, is lent out in other monetary tools. Now, if one bank, all of his clients come and try to withdraw money, then they might run out of that 10% of funds available. So they can turn to Bank B and say, Bank B, can you lend me some money temporarily, transfer me some money so that I can fulfill the need of my clients. Now, as rates were dropping, banks started to run out of liquidity. They tried to turn to each other, but everyone was having the same kind of situation. And it's, you know, it's kind of a very essential thing that you should be able to go to the bank and withdraw your money. And when liquidity starts hitting, that's when the federal government starts to intervene. So let's talk about what the Fed has been doing. The Fed has been preparing a huge stimulus package. There is talk about $1,000 per person bailout, up to $99,000 or $100,000 worth of annual income for those who need it. There's talk about bailout packages for some institutions, additional small business administration loans for businesses to be able to pay salaries even if they're not getting as much income, even if they're not getting as much business as they used to before this crisis. The government doesn't have all that money. They normally would have to issue new bonds to be able to do this. And the reason why they're doing this is if we're talking about, you know, the Secretary of Treasury mentions that otherwise unemployment can reach 20%. Now, just to put things in proportion, the Great Recession of 2008, unemployment was around 10%. During the Great Depression in the late 20s, early 30s, we've reached 20% unemployment, and that's where we are right now, and we might even get a little bit higher than that. So the federal government has to intervene fast, and they need a lot of money to be able to do that. So we're talking about printing money, and we're talking about all these other programs. But they also have to introduce additional liquidity into the market. And the way that they're doing this is that they're lowering the rates and reducing the barriers so that banks can borrow directly from the federal government instead of borrowing from each other, and making available cheap money to lend on mortgages and to small businesses and to individuals. They also offered to buy bank bonds, both government bonds and even some corporate bonds, and mortgage-backed securities to the tune of $700,000. It's probably going to be about $500,000 for bonds, and about $200,000 to begin with for mortgage-backed securities. But having said that, today they announced that they are going to pull all the stops, and they're going to do whatever it takes to keep the economy moving forward, liquid, and making funds available as needed to stay that way. So pretty much removing all the barriers on what was known after the 2008 crisis as quantitative easing, where they're buying back mortgage-backed securities. The problem is that hang on, okay, here we go. Mortgage-backed securities. So right now rates are swinging between very low to pretty low, and banks are having a lot of people trying to refinance their loans, and there are a few problems with that. First of all, the fact that when you lock your loans with a mortgage company, it doesn't magically get locked into the secondary market. The lender does not actually get to lock their rate until the loan is consummated, the money changes hands, and the transaction is closed. Now, they promise you a certain rate, and there is a price to pay for that, because if rates go down by the time that they actually are able to sell the loan, they make money. But if rates go up, and right now, with some of the liquidity issues and other reasons, rates are trending a little bit higher, they might lose money. So they buy gap insurance. And at a time like this, with so much uncertainty, the insurance companies, they also don't want to lose money. There's nothing that more insurance companies like less than spending money. They're in the business of making money. So when rates are trending higher, the mortgage companies issue a margin call and require the lenders to pay for the premiums up front. And this puts an additional strain on funds that are available to the lenders. And we're seeing a lot of lenders raising rates to deal with this, to reduce the demand a little bit, but also because they're having problems with liquidity. They don't have the access to the funds that they used to. Volatility is very high, as I mentioned earlier, and as unemployment grows, people might lose the ability to repay mortgages, and that is becoming a growing risk that we might see a little more foreclosures in the coming months, even though the government already announced some additional measures that we'll talk about in a moment. But when you see this kind of volatility in just one day, this is the kind of volatility that we usually see in a month. We're seeing that in a single day, and it's really hard for lenders to deal with this. Non-QM mortgage, non-qualified mortgage are the higher risk loans. Those are loans for people who are, for example, self-employed, and they're taking a lot of deductions on their tax returns. And we can use alternative ways to document their income, such as using bank statements and so on. These are higher risk loans. The interest rates on them is a little bit higher, but they're also going to be the first dominoes to fall in a financial crisis. The small businesses are the ones that are right now hurting the most, and those business owners are at an increased risk of not being able to pay their loans. So having that taken into account, we're seeing several lenders announcing that they're not taking any new locks, and some of them are even going to the extent of not honoring locks that were already placed with them. And so some of those products right now are not available. Things like jumbo loans, those are trending higher, a lot higher than conventional loans. Again, the risk when you're talking about jumbo loans is higher. We still have very good rates if we're talking historically, but they are trending higher. So if you are currently in a position where you still have income, we can still verify your employment, you want cash reserves, maybe you have some credit card debt that you're wondering if you will be able to deal with it if this crisis continues, this is a very good time to actually go ahead and do a refinance on your home, potentially a rate term refinance if you have a residential mortgage with an interest rate of above 4 to 5%, you may be able to benefit from rate and term refinance. And even if you have a lower rate, if you have a need to take some of the equity out of your house when house values are still high, because if the crisis continues, again, demand for houses might decrease and we might see a little bit lower prices. So this is a great time to take advantage when values are still high and try to do a cash out refinance and put some of that money either towards higher interest rate debt or to put aside some cash reserves. Some of the challenges in closing transactions these days are around things like appraisals. Can appraisals be done? Are the appraisers working? Are they also being quarantined? Are we able to contact your employer to verify your employment? Are government offices going to be able to provide documentation that is needed in the process, such as Social Security verification or tax verification? What about the closing? What measures are going to be taken to allow people to sign the closing documents, whether it is with or without a mortgage? There are measures in all states and even on the federal level that are moving forward to try and ease that a little bit, trying to enable things like electronic signatures. Today we have electronic tools, we have smartphone apps, we have web applications, we have video conferencing, we have all these tools that we can utilize throughout the entire process. But up until now, the final closing of real estate and mortgage transactions required in-person, ink to paper signatures. So there are measures for trying to go around that and make it legal to sign all those documents electronically like we can throughout the rest of the process. What about real estate brokers? Are you holding open houses these days? What about broker open? If the house is vacant, probably it's going to be a little bit easier. If the house is occupied, you don't necessarily want strangers coming in and walking through your house these days. So we're going to see an increased use of things like virtual open houses, virtual tours, 3D modeling of homes, and so on. We have very strict procedures for appraisals so that we can allow appraisals when needed. We do have these days more and more transactions where we get an appraisal waiver, but on a lot of transactions, especially cash out and investment properties, we still need to have appraisals done. So we're going to adhere to very strict rules where we ask homeowners to turn on all the lights, open all the doors, and the appraisers are going to do the best to not intrude, not touch anything, and stay in the house as little as possible and cause as little disturbance as possible. So we're taking all the measures needed to move forward safely for everyone. For real estate investors specifically, I'm hearing a lot of growing concerns about the ability of people to pay rent. In Washington State, Seattle was the first city to announce the moratorium, a 30-day moratorium on residential evictions due to non-payment of rent to people who are affected by the coronavirus closures and quarantines. There are also similar measures in the federal government. So we're going to see this as a growing trend, and you have to be prepared for that. I strongly recommend working with your lawyers and proactively contacting your tenants to make sure that you don't give up any rights, but you're also taking into account and considering the hardship that some of your tenants are having these days. You should also, if you have a hardship yourself because of tenants that are not paying, or even on your own home, if you have a hardship, contact your lender, and you might find some mortgage forbearance. I know that on FHA, for example, it's been already announced that you're going to have up to 12-month forbearance, removing all late fees and fines, penalties, and so on for non-payment of mortgages. But you have to contact your lender and discuss it ahead of time. Don't just stop paying because you're having a hardship. If you don't communicate, it's going to come back and bite you. But if you communicate with your lender, you're probably going to find that they're willing to work with you and work through this. So talk to them. I work a lot with financial advisors, and a lot of them talk about, dealing with buckets. So the bucket one is your short term, it's your cash, it's your credit cards, it's your car loans, lines of credit. Second bucket is your mortgage, cash flowing real estate investments, stock and bonds. And then the third bucket is if you're in retirement over the age of 62, a reverse mortgage, retirement accounts, 401k, IRA, Roth IRA, and for some of you, self-directed IRAs and self-directed 401ks, which allow you to invest in more asset classes. This is important to understand all the options that you have for you. And right now, you should be concerned a little more about your short-term bucket, and that's where your mortgage refinance is going to come in and help by spreading some of your debt over a longer period of time and allowing you to deal with the short-term crisis. And hopefully it will really be short-term. The faster we get through this, the faster the recovery is going to be, but you have to be prepared for this. If you're in retirement, if you're still paying a mortgage, but you have enough equity, about 50% equity, you might consider this a good time to switch to a reverse mortgage. A reverse mortgage will eliminate your principal and interest payments. You still have to pay your taxes and insurance, homeowner association fees, and any maintenance of your home, but you will get rid of the monthly principal and interest payments, which are the biggest drain on a lot of senior citizens on their retirement accounts. You will be able to have your money last a lot longer, especially when we're in a time where the stock market and the bond market and everything is crashing so badly. If you're drawing money from your retirement account in order to pay your mortgage, you're digging a deeper and deeper hole in your retirement funds. And I'm here to help you cut that loss and convert your mortgage into a reverse mortgage if possible. So contact me, let's talk about it. This is the time to fine-tune your financials. Don't spend money on things that are non-essential, but work with your supporting professionals, your loan officer, your financial advisor, your CPA, to fine-tune everything so that you don't get into deeper problems than you have to. Kenny Rogers passed away earlier this week. He said it, you know, you got to know when to hold them, know when to fold them, know when to walk away, and know when to run. So the same applies to real estate. You know, you should know when to buy real estate, when to sell it, when to hold, and when to leverage and finance your real estate for better possibilities. And there are going to be a lot of possibilities in the coming months. The longer this crisis continues, we're going to see some people getting into inability to pay their mortgages. Forbearance will help some of them, but not all of them. And some people are going to be very willing to pay, to sell their properties. And this is going to present some opportunities for real estate investors. So be prepared. If you're a real estate investor, be prepared to take advantage of those situations. Don't take advantage of the people. Take care of the people, but take care of yourself as well, and plan for your future. If you're able to get some cash out of your properties these days, that will possibly help you hold through this situation and be in a better position when we're through with it. If you want to learn more about real estate investments, please contact me or follow the link on your screen right now. And there are some great courses out there, and talk to me about them. I can help. If you have any questions, please email me, call me, or text me, and I'm here to help. Have a wonderful week. I'll talk to you again soon.